For a generation of young adults with 2 cents in their pocket and a $100,000 school loan for a degree they don't use, investing in the stock market can seem like a foolish idea. But when it's done well, you can take that 2 cents, convert it into 3 cents. That's a lot more than you had yesterday. Isn't that the point? In any seriousness, the stock market is frequently portrayed as a huge, dangerous abyss of money that devours naive investors, while also providing a road to massive wealth for those who understand it. While those perceptions may be accurate, understanding the stock market and succeeding in profiting from it is far simpler than you might think. To be able to comprehend the stock market. To begin, we must first define what a stock is. A stock, also known as a share, is a financial token or instrument that represents partial ownership of a corporation. In other words, if Amazon had 1,000 shares and you bought one, you would own 1,000th of the company. In truth, Amazon and other corporations own millions of shares, but that's all there is to it. When you buy a stock, you're buying a piece of a company, and as the value of that company rises, so does the price of your shares. There are also common and preferred stocks, which pertain to a shareholder's voting rights. Common shares have voting rights, but preferred shares do not. Voting rights allow you to vote on matters such as board elections, mergers, and other financial choices. Preferred shares, on the other hand, are so named because they get first priority when a firm pays a dividend, which is essentially a split of a company's earnings with its shareholders, and they also get first priority in other financial situations. Stocks can get a lot more intricate than that, but for the average investor, these basic concepts will suffice. The second question you could have is why corporations sell stocks, and the answer is simple: to make money. Stocks enable a business to raise large sums of operational cash with little effort or product. In today's stock market, a company's worth is frequently determined by its future profits potential. This means that relatively modest businesses can make millions, if not billions, of dollars if investors believe they will prosper in the future. So, if a corporation wants to sell its stock, they'll need a place to do so. Take a look at the stock market. Companies list their shares on an exchange by selling them in an initial public offering or IPO. This effectively transforms a privately held corporation into a publicly traded corporation. IPO can allow firm founders to sell their shares or simply allow the company to raise funds. The public can trade a company's stocks once they are listed on an exchange. Prices usually change in response to public opinion. The more definite patterns and variations, on the other hand, are usually determined by a company's earnings and operations. P/E ratios or price to earnings ratios, as well as a range of other indicators, can be used to assess these. This is normally where inexperienced investors get afraid and their eyes glaze over, but don't worry, it's not as difficult as it appears. The next step is to comprehend how and why a stock's price swings. The stock market is made up of millions of investors and traders who all have distinct perspectives on a firm. They all make their own decisions, and the sum of their decisions determines whether a stock will rise or fall in price. If more people buy, the price must rise. When everyone wants to get out of a business, the price drops due to a lack of purchasing desire. As an example, let's imagine you want to sell something on Craigslist for $100. You get 100 emails after posting stating, "Oh, come buy your item all cash right now." Most people will begin to believe that they have priced their goods too cheap at this point and will raise the price until they are satisfied. In principle, it reaches the maximum price that a single last buyer will be willing to pay for it. If you don't get any offers, you'll probably keep lowering the price until someone bites. This is similar to how the stock market works, except that the price rises and falls are caused by millions of transactions per second, which leads us to the concept of supply and demand. There must be a buyer and a seller for every stock purchase or transaction. The price will rise if there are more purchasers. The price will drop if there are more sellers. Traders frequently discuss the bid-ask spread, which is the difference between the bid and the price at which someone is willing to buy a stock. And at the end of the day, the ask, or the price at which someone is willing to sell a share, is very straightforward. If more people demand something, such as a stock, it will become more costly. Matching buyers and sellers on a trading floor was done manually at the outset of stock markets. Trading systems now do the majority of the work for us. This permits the market to move much faster, resulting in the dizzying pace that every casual observer of the stock market notices. Now, you could be thinking, well, I don't have time to grasp this, and why should I invest when I can earn 2 to 3% just by keeping my money in a high-interest bank? The solution is straightforward. Using a common example that you may have heard, You can make a lot of money if you execute it correctly. If you had invested $1,000 in Amazon stock in 1997, you would now have almost $1.5 million. Although that is a lengthy investment schedule, I believe most people would agree that the purchase is worthwhile. Other companies frequently offer annual return rates of 30 to 70%, which is still a significant amount of money when compared to the 2 to 3% in a bank account. In other words, as long as you can make more than 3% on the stock market, you're doing better than just keeping your money in the bank. Now that we've established that the stock market is a real-time marketplace where you may buy shares in firms you believe will prosper, the next step is to figure out how to do it. The first step is to open a trading account. You can start one with a common supplier like E-Trade or other major banking institutions, or you can use free trading services like Robinhood. Common trading services will charge fees for each trade you make. New tech businesses, such as Robinhood on the other hand, have made everything absolutely free. That means you may put all of your money into a company and not have to worry about paying brokerage fees. Once you've opened an account with any trading site, you'll need to determine which company or many firms' stocks to buy, which is likely the most difficult step. You'll also need a specific amount of money, as stocks can range from a few pennies to many thousands of dollars. The important thing to remember about stocks is that you can't buy half of one. It's all or nothing. If you wish to start investing in Amazon, you'll need at least $1,800 at the time of recording. However, for a few dollars, you may purchase much cheaper, well-rated businesses. Prior to making a purchase, you should conduct considerable study to ensure that you understand how a company makes money, whether it is in good financial standings, and what experts say about the firm and whether you should purchase it. At the end of the day, you must be willing to take some risks. As a result, it's critical that you only invest money that you can live without for at least a short period, or until a particular stock recovers if it falls on hard times. We've gone through the fundamentals of the stock market, how it works, and how to get started with it in this video. We didn't go into much of the technical research that goes into analyzing a firm, much of the language around stock trading, or even techniques to trade without having the money to buy stocks on leverage. That's fine for a first-time investor. Taking a few dollars you're willing to lose and getting your hands dirty and investing properly is the greatest approach to learn about the stock market and become involved. Thanks for watching. Kindly give this video a big thumbs up and see you in the next video.